Hello everyone. In today's class, we will be discussing classification of errors in accounting. These accounting errors, they can occur at any stage of recording financial transactions. And understanding these errors is crucial for maintaining accuracy in financial statements. Okay, so let's get started. So keeping in view the nature of errors, all the errors, they can be classified into the following four categories. They are errors of principle, errors of omission, errors of commission, and compensating errors. So now let's start one by one. In that first one is errors of principle. So it means what? Accounting entries, they are recorded as per the GAAP, means generally accepted accounting principles. If any of these principles, they are violated or ignored, errors resulting from such violation are known as errors of principle. It means what? We will record the accounting entries as per the GAAP. Okay. If we not follow the rules or these principles, or we ignore these principles, the errors resulting from such violation, they are known as errors of principle. Here I will explain this errors of principle through an example. See here, for example, a business purchases furniture worth rupees 20,000. Business purchases furniture worth rupees 20,000 but mistakenly records it as an expense. Furniture, it is an asset, right? But here what happens? They mistakenly records it as an expense under repairs and maintenance. So instead of capitalizing it under furniture account, here we have to record it as a furniture account because it is an asset. But here what happens? They mistakenly record it as an expense under repairs and maintenance. Okay. So here furniture purchase wrongly recorded as an expense. So here what is the incorrect journal entry then? Repairs and maintenance account debtor to cash or bank account. This is the incorrect journal entry because they mistakenly record the furniture as an expense. So the incorrect entry here classified the purchase as an expense instead of an asset. Here what happens? Violating the accounting principle. Violating the accounting principle that capital expenditures should be recorded as assets. Fine. Then what is the correct entry? See here, the correct entry is furniture account debtor to cash or bank account. This is the correct journal entry. So the correct entry ensures that the furniture is treated as an asset as per the accounting principle, which will be depreciated over time rather than expensed immediately. Okay, this is the accounting principle. But here they mistakenly record it as an expense under repairs and maintenance. This is called as errors of principle. Okay, so this error of principle may occur due to incorrect classification of expenditure or receipt between capital and revenue. So this is very important because it will have an impact on financial statements. Okay, this is about errors of principle. Okay, now we will see the next one, that is errors of omission. What does it mean? See here, errors of omission. Yes, error of omission. What does it mean? It means it occurs when a transaction is either completely or partially left out of the books. So error of omission, it occurs when a transaction is either completely or partially left out of the books. So these errors can impact on financial statements as well as in the trial balance. Fine. This is the errors of omission. Now we will see the error of complete omission and error of partial omission. So here first one is error of complete omission. It means what? In this, the transaction is entirely left out of the books. The transaction that is entirely left out of the books. That is the error of complete omission. See, for example, a business, it sells goods worth rupees 50,000 on credit to Mr. A, but forgets to record the transactions in the books. So here what is the journal entry? Journal entry is Mr. A's account debtor to sales account. What is the transaction? Business sells goods worth rupees 50,000 on credit to Mr. A. Journal entry is Mr. A's account debtor to sales account. But here neither sales account, neither sales account nor Mr. A's account is updated. Neither sales account nor Mr. A's account is updated. This is called as error of complete omission. Okay, I hope this is clear to you all. Next, we will see error of partial omission. Error of partial omission. What does it mean? It means the transaction is recorded in one account but omitted in another. So here in the error of partial omission, what happens means the transaction that is recorded in one account but omitted in another account. Okay. See here, see the example. A business receives rupees 30,000 from a debtor, Mr. B, and correctly records it in the cash or bank account. Means in one account they updated correctly in the cash or bank account but forgets to update Mr. B's account. They updated correctly in cash or bank account but they forget to update in the Mr. B's account. Here what is the effect? The cash or bank account, it is updated correctly. But here Mr. B's account, it still shows an outstanding balance leading to incorrect receivables. This is the error of partial omission. Means the transaction is recorded in one account but omitted in another. Means in our example, the amount that is updated in cash or bank account but forgets to update in the Mr. B's account. So the trail balance, it will not tally. Okay, this is about error of partial omission. In error of omission, there are two types: errors of complete omission and error of partial omission. In the error of complete omission, what happens? The transaction is entirely left out of the books. And in the error of partial omission, only one account it is updated properly and but omitted in another. Okay, this is about errors of omission. Now we will see the next one, that is errors of commission. Okay, errors of commission. Yes, errors of commission. What does it mean? It means errors of commission happen when an entry is made. When an entry is made but with the wrong amount, or in the wrong account, or with incorrect details. Okay, this is about errors of commission. This is about errors of commission. Okay, it means what? Errors of commission happen when an entry is made but with the wrong amount, or in the wrong account, or in the wrong account, or with incorrect details. For example, if rupees 5,000 that is received from Mr. A but mistakenly recorded in Mr. B's account, this is an error of commission. It means what? Here we have received rupees 5,000 from Mr. A, but here we recorded in the wrong account, means in Mr. B's account. So this is an error of commission, or wrong amount, means instead of rupees 5,000 we record it as an rupees 6,000. Okay, or with incorrect details. Okay, this is the error of commission. Okay, I hope this is clear to you all. Now we will move to the next one, that is compensating errors. Compensating errors. See, sometimes what happens, two or more errors cancel each other out and the trial balance still appears correct, means trial balance will tally. These are called compensating errors. It means what? Sometimes two or more errors cancel each other out and the trial balance still appears correct. These are called compensating errors. Here I will explain this compensating errors through one example. Okay, see here. Sales account is understated by rupees 5,000. It means what? Sales account is understated. Sales account, it means what? It is an income. Sales is an income. It is understated by rupees 5,000. It means less revenue or income that is recorded. And here actual sales is rupees 50,000, means they recorded rupees 45,000. And wages account that is understated by rupees 5,000. Wages, it is an expense. It means less expense recorded and our actual wages that is rupees 20,000, means they recorded rupees 15,000. Here sales, it is an income and wages, it is an expense. It means both income and expenses, they are understated by the same amount. See here 50,000 they are understated by rupees 5,000. Here actual wages they are rupees 20,000, but that is understated by rupees 5,000, means both income and expenses they are understated by the same amount, that is rupees 5,000. So the trial balance remains balanced. Trial balance remains balanced, but it is still incorrect. Because here the sales account that is understated and wages account it is also understated. Here our actual sales is rupees 50,000, but they recorded it as rupees 45,000. And here also wages, our actual wages is rupees 20,000, but they recorded or understated by rupees 5,000, means they recorded as rupees 15,000. So the trial balance remains balanced, but that is still incorrect. So the error in the sales account that is rupees 5,000 made total credit less. Make total credit less here. And what about wages? Error in wages account that is rupees 5,000, made total debit less. Okay. See, the error in sales, because sales it is an income, so made total credit less, that is rupees 5,000, means same amount. And here error in wages also made total debit less. So since both errors were of the same amount, the trial balance appeared correct but contained hidden mistakes. But here they contain hidden mistakes. Fine. This is about compensating errors. Means both income and expenses they are understated by the same amount of rupees 5,000. But the trial balance remains balanced, but that is still incorrect. Okay. They are contained with hidden mistakes. Okay, this is about compensating errors. So I hope this classification of errors that is clear to you all. If not, please leave a comment. Thank you.